You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Well, I've gotten a lot of comments about the morning session, talking about practice management, business valuation, and the feedback's been tremendous. So I got a lot out of it. I sure hope you did. Now I've got the distinct pleasure to introduce to you Danielle DiMartino Booth. She is the CEO and founder of Quill Research. I've been following her on social media. I've read her book. I read articles that she publishes, and I was so impressed, I just had to have her here. Danielle's background, I think what's most interesting is how she came up through the ranks of Wall Street, but the road that she took relative to her peers in the industry. It's in the first few chapters of this book, and we've got a copy for everybody out here. And after she speaks, and if you want it signed, well, she's going to stick around for a few minutes before she has to head to the airport. So Danielle's background is she spent nearly a decade at the Federal Reserve. She worked in Dallas working for President Fisher. And I've got a lot of friends who are friends of Danielle's friends, but President Fisher, and the remarks and the feedback I get on her and what she brought to the Federal Reserve and her time there was incredible. With no further ado, would you please give a warm Chicago welcome to Danielle Booth.
Thank you. Good morning, everyone. I've been running around in this lovely weather and in traffic and getting canceled by Lyft drivers. Always remember, this is your one takeaway for the day. Uber drivers are penalized if they cancel a trip without giving a reason, and Lyft drivers are not. I learned that the hard way a few weeks ago in New York traffic, lots and lots of New York traffic in any event. Last night, I started to introduce myself to Randy, and then I said, well, I'll save the best of it, because we started talking about University of Texas and accounting classes and how far he'd gotten, obviously much farther than I did, because I was 9 hours shy of sitting for my CPA when I left the University of Texas, and there were several job opportunities that were facing me, and of course I'm from Texas, so my mother was desperate for me to stay in Texas. Please, dear godchild. So I said, well, you know, this company by the name of Arthur Andersen, they've offered to pay my last 9 hours of accounting, put me up in wonderful corporate housing. I'd spend the summer in Austin, never have to leave Austin, sit for my CPA, and they're going to fast track me to this consulting thing, and I'll be working for big companies. And Mom's like, great, stay in Texas. And I said, well, you know, I'm not a bean counter. So I turned that down. And then there was this other company, and Mom was like, okay, fine, I don't like Houston, but if it has to be Houston, Houston. I said, but I just don't really understand what they do. I mean, I kind of get it conceptually. I mean, I'm a finance major. I get Wall Street. I've been reading the Wall Street Journal since I was in diapers, but what this company named Enron is trading, I just don't quite get it. So I said, plus, Mom, I've got naturally curly hair. I'm not moving to Houston. So she said, well, what is it? It sounds like you're going to go work for an airline company. I said, what was that, DHL? And I said, no, DLJ, Mom. It's an investment bank in New York. I promise it's established. It's the first investment bank founded after World War II, and it's going to be great fun. And she's like, but they're not paying you anything. And I'm like, well, no, it's something where you have to eat what you kill, and you produce. And that is where I started off on Wall Street. I turned down offers from Bear Stearns and Lehman Brothers as well, and at which point you're all going to run out and go buy a lottery ticket on my behalf. Landing at DLJ was probably the best thing that ever happened to my career. It was truly an entrepreneurial organization. This was heading into the dot-com boom, so the parallels that I see with today and companies with no profits coming public are they're uncanny. I'm spooked out every day, because if you add up today's leverage, it feels like 2007, but if you add up today's stock market behavior, it feels like 1999. So if you put the two together, it's kind of where we are today, but I'm getting ahead of myself. What did I learn when I was at DLJ, however, was the true meaning of price discovery, what markets are meant to do when they function naturally. As the years went by and in the near decade that followed when I was advising Richard Fisher at the Federal Reserve, I got to know a gentleman by the name of Arthur Cashin very well. We are dear friends to this day. I see him every time I'm in New York, and he has been kind enough over the years to pass along to me some of his stories, some of his recollections, even those that I'm going to read you now that preceded him, but he'll tell me about the day that JFK was killed in Dallas and how he knew it before because the market told him so. The ticker tape told him so, and he'll regale me with stories about the afternoon of 1987 and the following morning when Corrigan, who was running the New York Fed at the time, forced the stock market back open by telling the biggest broker-dealers, if you still want to be a broker-dealer and if you still want access to the window, then damn it, open up these credit windows and open them up now. And lo and behold, we had that hockey stick that started on October the 20th. But this is my favorite story that he's ever relayed to me. It helps explain to my 4 children how exactly it is that markets are meant to function. I will share it with you. So the story involves 2 gentlemen. One, a gentleman by the last name of Tiffany, and 2, J.P. Morgan, the investment banker. Being the astute jeweler that he was, Mr. Tiffany knew that Mr. Morgan had an acute affinity for diamond stick pins. One day, Tiffany came across a particularly unusual and extraordinarily beautiful stick pin. As was the custom of the day, he sent a man around to Morgan's office with the stick pin, elegantly wrapped, of course, in a robin's egg blue gift box, with the following note. My dear Mr. Morgan, knowing your exceptional taste in stick pins, I've sent this rare and exquisite piece for your consideration. Due to its rarity, it's priced at $5,000. If you choose to accept it, please send a man around to my office tomorrow with a check for $5,000. If you choose not to accept, you can send the man back with the pin. The next day, the Morgan man arrived at Tiffany's with the same box in a new wrapping in a different envelope with a note which read, Dear Mr. Tiffany, the pin is truly magnificent, but the price of $5,000 may be a bit rich. I have enclosed a check for $4,000. If you choose to accept, send my man back with the box. If not, send back the check and he will leave the box with you. These decisions. Tiffany stared at the check for several minutes. It was indeed a great deal of money, yet he knew that the stick pin was worth $5,000. And so he said, you may return the check to Mr. Morgan. My price was firm. So the man took the check and placed the gift wrap box on Tiffany's desk. Tiffany sat for a few minutes thinking about the check he had returned, and then he unwrapped the box to remove the stick pin. I bet you're guessing what happens next. When he opened the box, he found not the stick pin, but rather a check from Morgan for $5,000 and a note with a single sentence. Just checking the price. Yep. Yes, I love it. I cannot. People are like, are you ever going to stop telling that story? And I'm like, maybe when I'm dead. But I'm going to have it read at my funeral. Just checking the price. That, my friends, that is how markets are meant to operate. That is how natural financial markets function. But I'm sad to report that that has not been the case since October the 20th, 1987. I mentioned that a little bit earlier. Well, why not October the 19th? There's another quick story there. Alan Greenspan was in the air on October the 19th, 1987. He was headed from Washington, D.C. to Dallas, where he was to deliver a prestigious economic address. He lands in Dallas. He's rushed at by a Dallas Fed Reserve staffer and handed one of those brick phones from Wall Street, and the guy's like, the market crashed while you were in the sky, sir. To this day, 23% decline, biggest we've ever seen in U.S. history on a percentage basis. Suffice it to say, Alan Greenspan did not make the speech the next day. He rushed back to Washington, D.C., at which point the Federal Reserve issued the following statement: the Federal Reserve, consistent with its responsibility as the nation's central bank, affirmed today its readiness to serve as a source of, I feel like I should put a hashtag in front of it, even though they didn't exist back at the time, of liquidity. Hashtag liquidity to support the economic and financial systems. He was not kidding. In the weeks and months that followed, Alan Greenspan, this is the fall of 1987, would go so far as to leak information to bond trading desks on Wall Street ahead of Fed moves by the New York Fed open markets desk to inject liquidity into the system. It's the day the music died. It's the day price discovery died. It's the day that front-running the Fed was born, and it is when the Greenspan put was born, and price discovery, as we learned about in business school, started its slow death. That was over 30 years ago. In the time that has since followed, we had Orange County melt. We had the tequila crisis at the same time, 1994. Anybody remember that? Bad time in bonds. Alan Greenspan rode to the rescue again. 1998, long-term capital management. That is when a lot of people say moral hazard came to be, because an academic-run hedge fund threatened to blow up the global financial system. Alan Greenspan to the rescue again. In the years that followed, the term lower for longer was to be born. Don't fight the Fed came about. Alan Greenspan kept rates for so low for so long that we inflated the housing bubble. In 2003, he was approached by one of his closest friends and somebody on the board of the Fed, and he said, you know, we've got a situation on the West Coast. There's this orange man named Angelo Mozillo, and he's making a lot of mortgages, but we're worried about this subprime thing. And Greenspan said, the Fed only regulates 25% of the mortgage market, so it's only 25% our problem. So he didn't get out in front of it at all. Ben Bernanke came along, his successor, in the years that followed the aftermath of the subprime crisis of over 10 million homes being lost to foreclosure, and he doubled down on Alan Greenspan's put. He introduced the zero bound, even though there were a few inside the Fed at the time who were saying markets are frozen. It is not the price of credit that is at issue here, sir. It is that the credit market has shut down. We don't need to lower interest rates beyond 2%. We don't need to go to the zero bound. If you do go to the zero bound, you're going to have a hard time coming back from the brink. Bernanke said, thank you, sit down, took rates to the zero bound on December the 14th, 2008, and started quantitative easing, the first round. This was followed a few years later when there were a few on the inside saying, you know, I think the market can handle life off of QE, off of the methadone. Bernanke said, thank you for your input, sit down. We got QE2. QE3 came along, and there were a few rookies on the Fed. Jeremy Stein was one of them. He lasted all of 2 years before he left and returned to academia at Harvard and discussed. Another rookie who was brought on at the same time in June of 2012 raised his hand. He said, I think this whole QE thing might be habit forming, with all due deference. He said, I think that we are blowing a fixed income duration bubble across the full credit spectrum, and that one day, if we were to try to raise interest rates, it might be problematic. It might make it to where exiting is impossible. Jay Powell, October 2012. First person since Paul Volcker to walk the halls of the Eccles building who's not a PhD in economics. First person who came up in front of Congress in 30 years in his first congressional testimony in February 2018 when the Bless you. When the senator said, we've got a problem here, the stock market, we have to pay attention, Jay Powell said, talk to the hand. Heisman, don't care about the stock market. We had hope, some of us who had been on the inside of the Fed, because there were a lot of distortions in the market. I'm going to try and show you a few. There we go. There were a lot of distortions that being lower for the longest had introduced. Right here you see the investment grade bond market. I have to put my little clicker down because we have to put investment grade in air quotes these days. Because we now have triple B, which is one rung above junk, being larger than the rest of the entire investment grade bond portfolio combined. The downgrade possibilities are, well, I don't know, they're unprecedented. I don't know what they are. We're going to find out one day. Maybe, we're hoping not. As you can see, we've got $1.2 trillion of leveraged loans. I will never forget a Moody's high yield analyst telling me what a leveraged loan was. She said, I'm just going to boil it down to this. If you're a junk bond issuer and your balance sheet is so crappy you can't access the junk bond market, then you just go get a leveraged loan. Just remember it like that, plain and simple, Danielle, move on. Great. Now we've got more leveraged loans than we do junk bonds, as you can see. This is something that was bothering Jay Powell when he was appointed chair of the Fed. When you have interest rates at the lowest level for 5,000 years, according to Merrill Lynch, I did not fact check. Who has the time? But I took them for their words at it. But you would think that a company's net leverage and or interest coverage would not look like that. Not with interest rates barely off of the zero bound. Remember that in every recession we have ever entered in the history of Fed, going back however far you want, we've had interest rates at least double, at least 5% where they are now, 2.5%. We've had at least double the amount of bullets in the chamber headed into a slowdown. If you're not familiar with the work of Christopher Cole, he is probably the smartest guy in the world when it comes to volatility, specifically short volatility. You may have seen over the weekend, it was all over my Twitter feed, it was all over the place. You may have seen that if you combine the 3 different forms of being short volatility today, we are shorter than we were going into the volatility Volmageddon that happened last late January, last February. More people are convinced today, more investors are convinced today, based on their positioning, that the best place to be in the market is short volatility, meaning stocks will rise. This is the melt-up. We're in it. We're witnessing it. Anyways, Chris Cole, Artemis Capital, Google him. Some of the best stuff you'll ever read about volatility, its underlying causes, what share buybacks do to volatility. This is his data. As you can see, we prefer the earnings per share in a post-buyback world, clearly, because we would not have enjoyed near the stock market appreciation had companies not been buying back their shares at record rates, which, by the way, has continued. We'll get to that in a minute. Here is your global reflation trade. In the first quarter of 2019, China injected nearly $900 billion into its banking system. $900 billion in 3 months. If you can remember QE Infinity here in the United States, it was $85 billion a month. I mean, it's hard to wrap your head around how the People's Bank of China is capable of even getting that much money out there in the first place. But they were a little worried because their country had slowed down to the slowest rate in 30 years. So they had reason to be worried. And the beauty of the People's Bank of China and how it executes, shall we say, stimulus, is that rather than how the Fed does, which is nice and polite, we say, please lend, we're going to lower interest rates, we're going to synthetically lower interest rates lower than zero by deploying quantitative easing. The People's Bank of China just gives banks an offer they can't refuse. And that's how they deploy their QE, in Mandarin. And the banks protest it, saying, we know the loans we're making are going to be at a loss before we even make them. At which point officials said, and make the loan. So you have this surge. You saw overnight that Chinese industrial profits rose at the fastest pace in years and years. 13.5% they rose in Q1. That was after crashing in Q4. And you would think with that much money, coupled with the Powell pivot, remember, China started injecting stimulus in conjunction with the Powell freakout, which we'll get to in just a minute. But the point is, you had over $1 trillion of liquidity in 3 months' time, plus share buybacks at record levels. How could the S&P 500 not be at record levels? It would be mathematically impossible. It would defy Newton's law of gravity. It would make no sense given the amount of liquidity that's been thrown at these markets. And yet, you see the global auto industry on this slide. Germany, Japan, South Korea. You see their PMIs. It's hard to believe that they're not reacting. Central bankers, in order to confuse people, which is their full-time job, they use a term, transmission mechanism. If you look at this, it shows that the transmission mechanism of stimulus has failed. You want for it to go through to your major manufacturers, to your biggest industry in the world manufacturing-wise, which is automakers. And yet we see what we see. The yield curve inversion was not just a United States phenomenon when the yield curve first inverted in December. We see a flattening out in the global yield curve as well, in the face of over $1 trillion of liquidity. Okay, it's back. This is from but a few months ago. Ned Davis Research put the probability of a global recession at approximately 96%. Not much wiggle room there. Now, it's come off the high boil, right? We saw PMI in China rebound. We've seen here in the United States our own PMI rebound. It cost us a lot. The question is, how much time have we bought? Which is, of course, the multi-trillion-dollar question. I can speak in trillions because I'm a former central banker. It's the first thing they teach you how to do. Don't speak in millions. Don't speak in... We just throw trillions around. Whoop. They told me about this little... Yep. And to think I don't drink coffee. So ask yourself the question. Let's give you the most up-to-date point. We had a 3.2% GDP print on Friday. It was like, oh my gosh, there's no recession. This is the strongest first quarter since we entered the current recovery. Was it mostly driven by government spending and one of the biggest inventory builds we've seen in all time? Yes. Did durable goods spending by households decline by 5.3%? The steepest rate of decline since 2009? Yes. Piece I put out this morning in my Daily Feather, University of Michigan sentiment report last Friday morning. University of Michigan right here, this wonderful place. They put out wonderful survey data. They query your clients. They query people based on how much they make. Top third, middle third, bottom third. I think you could agree that the top third we call boss. The top third of income earners last month, their perception of the U.S. labor market going forward was at its most pessimistic since 2009. This has nothing to do with what the lower tier thinks job market prospects are. But that's because they're the last ones to find out. The boss fires the workers. Again, the disconnect wider than any time since 2009. What happened in Friday markets trading? Stocks traded up to record highs. The 10-year bond broke 250 on the downside. Always ask yourself which of the two markets is telling the truth, and then do a liquidity check based on your local central bankers and stay long all day long. So here is the question. Remember before I said, is this 1999 that we're in today, or is this 2007 that we're in today? Now, if you don't have your CNBC on mute, then I recommend that you put it there. And sometimes I'm even on there, squawking away. But most of the punditry will tell you that what we have post last December, when we inverted, is 24 months of runway time based on the episode that followed the November 2005 yield curve inversion. Are we good with yield curve inversion talk here? Yes? No? Maybe so? Good. Great. So most will tell you that we've got a good 24 months in front of us from the point of yield curve inversion. The episode that followed the 1999 overvaluation in the market gave us 12 months. Why? Because when assets are overvalued, especially when you're talking agnostically about commercial real estate, high-end residential real estate, stocks of any kind, bonds, when overvaluation is present, that means that your runway from point of inversion to onset of recession is that much shorter. You have less wiggle room if you build up extreme levels of overvaluation in risky asset prices. It's just the way the world works. So will we be in recession by December? I can't tell you. What I can tell you is that there is a new man in town, there's a new sheriff in town on the Federal Open Market Committee. He came from PIMCO. His name is Rich Clarida. He's the most important change agent to set foot in the Eccles building. If you could imagine Mario Draghi and Janet Yellen being fused together into one human being, that's how dovish he could be for financial markets. He has introduced the idea of an insurance rate cut. It's a term that's going to be bandied about with greater frequency, insurance rate cut. What insurance rate cut means is the United States economy is technically expanding, but just in case the Federal Reserve is going to lower interest rates. They're trying to buy time. By the time we had Friday's blockbuster data hit the wires, they had increased the probability of a rate cut in 2019 to 70%. That's in the trading pits in this city. That's just off the highs of 80%, which were kind of around the Christmas Eve meltdown in stocks. So we've made a round trip back to the market anticipating the Fed continuing on its easing cycle, right? On Wednesday afternoon this week, we will hear Jay Powell say that everything is on track to stop quantitative tightening. They're going to slow the amount by which the Fed's balance sheet shrinks beginning in May. Quantitative tightening ends by September. And all markets care about, the stock market, all the stock market cares about is what's next. Meaning, are you going to give us what we're asking for, 70% high of probability, are you going to give us that rate cut by December? Little known factoid, once the Fed, since 1970, once the Fed begins a rate easing campaign, on average, you see 125 basis point rate cut per month. So set your calendars, except for the fact that BlackRock, others, Larry Kudlow, of course, our president, but there's a growing cohort of individuals who are saying if it's really going to be an insurance rate cut at all-time highs in the market, in an expanding economy, but if you really want to take care of that situation with a really strong economy, then you might want to go a half a point, 50 basis point cut, just so you take out enough insurance. It's like a young gal marrying a 99-year-old guy. She wants just in case. But that's kind of where we are today. That is kind of where we are. It is surreal to be in my shoes because every single penny of debt that is taken out right now, in the event you're taking notes, right now the bond trading desks of the world say that once QE is deployed here in the United States, because we've only got what? If it's a half point, we've got 5 rate cuts. If it's 25 basis points, we've got twice as much, which puts us in QE by election day. Bond trading desks right now are saying $100 billion a month, Fed balance sheet up to 8, 9, or 10 trillion, give or take. We don't know. I mean, it's surreal to be having these discussions. Absolutely surreal. Because Ben Bernanke used to testify to Congress and say that what we're doing here is temporary in nature. We're going to blow the balance sheet up. We are, but this is temporary. We're going to bring it right back down to where it was. We're going to normalize. My boss, Richard Fisher, at the time was going, we're monetizing the debt. To which Bernanke was saying, no, we're not. Shh, Richard, stop it. You're scaring people. Well, guess what? We've gone from 4.5 to 3.8-ish. Powell is saying, hoping, praying that we get to 3.5. But every single penny that the Fed balance sheet grew, that as Bernanke promised cannot be unwound, is effectively, it is debt monetization in the United States of America. Think about that. We're monetizing the debt to the extent that we cannot unwind it. But investors tend to get what investors want. Before I open it up to questions, I will tell you why Powell pivoted. Show of hands first. Powell caved to the White House. Look at you, just a few. Good. He didn't. He didn't. Powell caved to the stock market. Wow, okay. So Powell caved to the credit markets. Because that's what happened. So I'll leave you with this story, and then we'll have questions and maybe Bloody Marys. Who knows? On Halloween, 2 things happened on Halloween Day. And again, Jay Powell, as I mentioned last night to you, Randy, and as I mentioned earlier, Jay Powell founded the Industrials Group at the Carlyle. He speaks to hundreds of CEOs. He speaks their language. He knows what EPS is. He knows damn straight what a margin squeeze is. 2 things happened on Halloween 2018. General Motors had blowout earnings. They were stupendous. They were spectacular. They were wonderful. By the way, we're going to lay off 1/3 of our North American workforce. That was in a little footnote with an asterisk at the bottom. Just a little by the way. We're going to give them voluntary buyouts, but only if they've worked for the company for 12 years or longer, meaning they'll never get that kind of income again, so why would they ever accept that? Guess what they didn't? GM pushed through with firing 1/3, just a small number, little accounting thing, of its North American workforce. Same day, Moody's downgrades General Electric's bonds. Moody's downgrades General Electric bonds into a nervous market. Remember October? It was not pretty. Because when S&P downgraded GE's bonds, nothing burger. The second downgrade, though, of GE's bonds unsettled things in the credit markets. Within 2 weeks, November the 14th, the junk bond market closed for issuance. Adios. 41 days later, record time in U.S. bond market history, 41 days without a single junk bond being issued in the United States. At which point, Jay Powell said, Uncle. The Bank of International Settlements, the World Trade, the World Bank, the World Trade Organization, they'd all taken notice because what people were pulling out of bond funds with liquidity down by approximately 90% post-Dodd-Frank, so you don't actually have banks and dealers backing bond trading anymore that you used to, which is problematic but untested. But the BIS and other international organizations took note and said, good God, your entire credit market's at risk of freezing. And you can't have your credit market freeze because we've gone from 170 to 220 to $244 trillion of debt worldwide. We cannot have the credit markets freeze. And so Jay Powell whispered QE nothings on a stage with Janet and Ben, and we all sang Kumbaya, and the markets came back, and it's been so awesome since then. It really has. Junk bond market opened back up for trading. The only thing that really hasn't responded, which shows you that there's one rational investor left out there, is triple Cs. They're the only thing that haven't recovered is the bottom rung of the high yield market. Otherwise, everything has come roaring back. But remember this, when it comes to a country that since the 1960s has had to create 4 times as much debt in order to generate the same amount of GDP. Yes, we're addicted to it, but we get less for it. It's called the law of diminishing returns. Just keep your eye on the Chinese market when you wake up every morning. The People's Bank of China last week said that we would like to ratchet back the level and pace of stimulus. And for the past 6 trading days, the stock market has replied with a 7% decline. Children do not like to have their pacifiers taken away at all. And the world in 2019 could see a melt-up. We could see 4,000 on the S&P, but it's going to require insurance rate cuts, more sweet talk of QE, and for God's sake, China not letting their foot off the accelerator. But stocks can go up from here because policymakers are frightened enough. If stocks decline enough, if bonds freeze, one thing happens in the United States of America. The CFO is directed by the CEO to pay attention to the balance sheet. This is the worst thing that can happen in our country. AT&T's got $182 billion of debt. You cannot have your CFO pay attention to the balance sheet, which means it's code for stop the share buybacks. Nobody else is buying stocks but companies. So if you stop the share buybacks, the market throws up. So China, grease the skids, keep the credit markets open, Jay Powell, Rich Clarida, keep the share buybacks coming, over $1 trillion this year, let's go. Buy it back, and you'll be fine. Slow it down a little bit, you're screwed. But I do have great hope after spending the weekend in Culver, Indiana, that higher education in this country has got great strides going forward. So I'm trying to end on a positive, happy note-ish. We can educate our children better, and vocational training is coming back, and 90% of Germans graduates get jobs right out of school, and their labor force participation rate is multiples of what ours is, and there are politicians who don't want to go to socialism and who instead want to bring vocational training back. Go Team USA. I'll take some questions. Yes, sir. If we keep, yes. If we insist on going down this path, if we insist that companies that should otherwise restructure, not restructure by virtue of the capital markets staying open and keeping them alive, then yes, we will have the zombification of corporate America, slowly but surely.
Question over here.
Well, he's almost finished with his question.
How does it impact the dollar on the world stage?
Well, right now it's a race to the bottom, isn't it? I mean, what are the implications for the dollar if we're going to have this big Japanification? And it's a great question, but you've seen that the European Central Bank can't raise interest rates out of negative territory. God, the euro's at 111. You've seen that Kuroda's like, okay, fine. If you insist, we'll buy call options on stocks, which he said last week out loud in public. Out loud. So Japan owns like all of its ETFs. Now it'll start buying call options. I mean, maybe they'll have them on fast money in the afternoon. I don't know. I don't know where this goes. But by virtue of the fact that you've got so much of the rest of the world in negative interest rates and our 10-year still at 250, it's all a matter of relativity. We're still relatively more attractive. So you see bizarre things like Friday's trading when the 10-year broke 250 on the downside, closed at 249, and the dollar strengthened. It's just a weird world. But remember that other people are doing worse than us, and we've got that going for us. So, yes, sir.
A question regarding the Tax and Jobs Act. I'd love to hear your opinion on how that has played out and the effectiveness of it trickling through the economy.
So that was also in my Daily Feather, shameless plug, today, when you can find me at quillintelligence.com. If I can get this oh, there we go. Because when we noticed that there was this great disparity between what owners, managers saw in terms of what they're thinking for the job market, like I'm going to be writing pink slips, versus workers, meaning this is the best time of my life, we also noticed news heard and this massive disparity between kind of owners, managers, and the lowest earners. And Richard Curtin, who's been doing the University of Michigan study forever, said that it is the reversal of the tax effect sugar high, basically. A year ago, corporate America was like, this tax bill is the bomb, and it's going straight to my bottom line, and it's fantastic. And on April the 15th, the same guy was like, my tax bill's what? I owe what? So he's like going, okay, this salt state business has got to be big. I'm moving to Florida tomorrow. But the point is, tax refunds net, this is Goldman's math that I've been keeping up with on a daily basis, but as of Thursday's close, the increased amount Americans have spent on refunds, the decreased amount Americans have received in refunds, plus what they have spent more on taxes is at $24 trillion year over year. So the love affair with the tax bill's over. Some of it's ignorance, some of it's 80% of Americans surveyed by H&R Block didn't know that they needed to adjust their withholding, which means that 20% were not surprised on tax day and 80% were. So it's not that we didn't get bigger paychecks, it's that perversely in our country where people can't save, they use their tax refund to go to Disneyland. And what did we see yesterday on the wires? 40% fewer Americans are planning a summer vacation this year because people use their tax refunds as savings plans. As crazy as that is, it is what it is.
Were you part of Lacey Hunt when you were at the Dallas Fed?
No, but we're good friends. I'm not that old. Sorry. Sorry, Lacey.
You have better hair, too.
Thank you. More.
My question is that he has been on a rant since like 2006 or 7.
And right.
And right, totally right, 100% right, about the fact that rates cannot go higher because of the massive indebtedness. And one time he was given a presentation that I attended at a meeting, and he said in the elevator, he said, today I'm using only international studies because there's so much politics in the room. If I use a U.S. study, they'll say I'm anti-Democrat and pro-Republican. But he did have international and in U.S. studies, and it always showed in history, modern history.
Yep.
There was no way rates can go up, and he loved to quote Adam Smith, that debt is future consumption denied. So I was wondering.
It's true.
A lot like his thinking in this whole.
Well, look, this works until it doesn't work. It works because the glue factory's on hiatus. It's like when they shut down the auto plants. We're still the least attractive. We're still the most attractive horse in the glue factory, but we're still in a glue factory. It's just a glue factory shut down for maintenance, and it has been for a while. But let's just say that coming out of the next global downturn, whenever that is, according to central bankers, approximately never, the business cycle's been eradicated, et cetera. But every time you try and change the rules to the extent that you are, it means you have to take on more debt, to Lacey's point. And that means that every dollar that you have to dedicate more of that dollar to servicing that debt, no matter how low interest rates are, which means that you've got less to spend on your flat screen TV, which is why in a weird world, we've got the printing presses running at full tilt and deflationary impetuses in goods and lower interest rates. All of this works as long as the Chinese continue to step up to our treasury auctions and need us as much as we need them. It has to be a copacetic relationship. If it's not a copacetic relationship, it falls apart. We flip the switch one day, The Chinese have stepped back from our treasury auctions. They can stand on their own. They've turned the tanker inside the narrow canal to where they have more domestic-led consumption, more of an American economic model, to where they don't necessarily need our dollars and therefore have to buy our treasuries. Step back, you go one day from having deflation to inflation. And that's the risk. But right now, we retain reserve currency status in this country. And as long as we retain reserve currency status, we can break the rules more than anybody else. Hence our attractiveness in the glue factory. Yes?
Thank you. Your comments about when we switch from deflation or disinflation, not deflation, but disinflation to inflation are they're consistent with the loss of the reserve currency status here in the United States. That's inevitable given economic realities. But I'd like to take the conversation back to your curve inversion, possibilities of recession. Isn't it more impactful that, not that 2's 10's inverted very briefly, but that the 3-month 10-year Treasury curve inverted for 4 trading days in March, and that's really not enough to indicate necessarily a recession, a higher recession probability, because there are other factors at play. You've mentioned a few: the global fixed income environment with negative 10 years in Germany and negative rates in Japan and 5-year rates in Switzerland. But the idea that there's other factors influencing the 10-year, which is the top end of the 3-month 10-year curve, and holding it down, including a negative term premium. These are things that are perhaps making the inversion signal somewhat less impactful, correct?
Well, the flip side of that is if you've had the Fed buying back and trying to move towards the shorter end for as long as they have, that you might not have gotten, and this is something that Raul Paul at Real Vision and I, we've gone back and forth on. The flip side of that argument is, what if suppression of rates has actually has actually postponed when the yield curve in a normal world would have inverted? And that's the other side of that coin, is that we could actually have a different disconnect than what you're describing.
Sorry, I don't understand. Are you saying that there's some impact on 10s that is holding 10-year yields lower than they would
than it otherwise would be, because
I agree with that, but so what is keeping the curve from, in your opinion, what's keeping 10s at 250?
Well, I think, it's a multitude of things. The biggest driver right now, I think, of the 10-year is global relativity. Yeah. I think that is the biggest driver. And the flip side of that is you've got pension funds that are in the soup. If I'm studying right now pension fund surveys for the year, and the most important thing for pension fund managers is risk management. So people talking about there being no demand for our 10-year, no demand for our 30-year, every time the pension funds get the opportunity to go long and match their assets to their liabilities, they do. So despite the fact that there's no risk return. But remember the one thing about the 3's 10s, though, because you bring up the most important yield curve inversion. That's actually the 2's 5's that I put up. The 3-month 10-year is the one used by academics and Wall Street to make their recession models.
Agreed. Last question, sort of a follow-up. And for years it was, with Fisher being reasonably, well, not reasonably, rationally hawkish.
Rational, yes.
But yet inflation has not been a problem. In fact, we got a 1.6
No,
print
he and I
in
went
PC
toe-to-toe
core.
the whole time, because I was in Lacey Hunt's camp and he was in his, he knew his German history.
So you believe then that there's that QE does have some sort of, an expansion of the balance sheet has some sort of benefit. That is, it isn't all bad, right? It did keep us out of a great recession in 2000.
QE1 did. QE1 did. But again, this was something that the Fed created. The Fed created the subprime crisis. The Fed created the subprime crisis knowingly. We would have never had liquidity freeze up completely had it not been for the actions of Ben Bernanke and Alan Greenspan.
I would say macroprudential regulatory issues created some of that as well.
Should Alan Greenspan have increased stock margin requirements in 1996 when he said irrational exuberance? Yes. That's the absolute answer. is that macroprudential's several decades too late, and that they should have been implemented a very long time ago before you have the NASDAQ crash necessitate keeping rates for so low that you create the housing bubble, which in turn creates the backdrop for quantitative easing. I mean, again, these are things that, in Alan Greenspan's biography, it comes out that he knew he was doing the wrong thing at the time, but he couldn't stop. He couldn't help himself because he hadn't been popular in high school. Look, it's in his biography. The guy shouted him for 2 years. He knew he was kowtowing to Washington, is all I'm saying, and you cannot kowtow to Washington when you're supposed to be an apolitical, independent central banker. He knew stock margin requirements should have gone up in 1996. We wouldn't have had the NASDAQ bubble had that happened. But it's so much easier to go the easy path. And that's why Jay Powell caved. Sadly enough.
One more question.
Do you have any thoughts on tax rates long-term and what they're likely to do?
Ugh. That's why I brought up vocational training, so we didn't have to bring up socialism.
What was the question, Danielle?
Because you get A or B. I mean, you get people. I mean, look, I was in the state of Indiana over the weekend. That has the highest concentration of input to its gross state product of manufacturing. It's the top one. It's the first state in the nation. We're also seeing jobless claims increase. We're seeing the manufacturing come off of its high. So I bring up this micro information to say that if the blue states that elected Trump are angry next year and looking for an alternative, then I just hope it's not socialism, because then you're talking about much, much higher tax rates. So I hope we don't go there, is what I'm saying.
Danielle, thank you. Terrific.
You don't want to see me take a flying leap in these.
Danielle, that was terrific. Now you can see why I wanted to have her here. She's not only just, I think, fairly intellectual, but she's a little bit entertaining too. So I would encourage you to go to our website, check out the Quill research. I'm giving her that shameless plug because I spend time there reading, and so that was the reason we wanted her here. As a reminder, at lunch, she's going to stick around she has just a few minutes before a flight, but there is a book out there called Fed Up, and I would encourage you to read it. It is entertaining, much like her. She writes much in the same way she speaks. So with no further ado, we're going to move forward, and she's talked about a lot of issues, that are on the horizon around the economics markets, volatility, debt, and how do you address that at the portfolio level? So that's what I'm going to invite up our two members of our portfolio team, Mark Odo, who's our client portfolio manager, and Chris Hausman, also a portfolio manager and our chief risk officer for the firm. And they're going to walk us through and give you more of a deep dive into what we do and how we help you address some of these issues at the portfolio level, because there will be a day of reckoning. I think we're all aware of that. So Mark, Chris.
All right, great, thank you. Yeah, I really couldn't ask for a better introduction than what Danielle's topics were, and I think it stands in kind of stark contrast to some of the things that we talked about in the first session, the morning sessions. I mean, what was one of the main themes about the practice, whether you're a buyer or a seller? It was sustainability, right? Let's keep this business that we've built going for 5, 10, 20 years. I want that to almost be my legacy even after I've retired. And yet, on the other hand, we've got these factors working against us that none of us, doesn't seem like anyone has any control over. So how do we kind of help address this here? So what we're going to do is talk about the defined risk strategy, which has been around for about 20 years. And in fact, one of the stories we like to tell, the impetus for Randy starting this thing, was this idea that we have entered this period of irrational exuberance. So the first question here, as we talk about the defined risk strategy, is why does it exist? What is it meant to do? Why do people, what is this meant to solve here? And really, the way that I like to think about it is that our core belief, our core fundamental belief, is the biggest risk that any investor faces out there is market risk. It's systematic risk. It's that the markets will have one of those periods where it sells off by 30, 40, 50% again. Now, granted, we've seen this twice since the new millennium started, right? Since the 2000s, we've seen the biggest two sell-offs since World War II happen. Now, of course, everyone's kind of forgotten about that. We're up here 10 years later, markets setting all-time highs, and we've got some very great insight as to what drove the markets to those, but this is still the biggest risk that anyone ever faces here. Now, the traditional risk management technique that a lot of people use to address this is diversification, right? Asset allocation. Modern portfolio theory, the idea you don't put all your eggs in one basket, which is a fine idea, but there are problems when it comes to implementation, right? Well, everyone has these efficient frontier tools. Everyone looks at the putting in these correlation numbers and expected returns, expected risks. And if you do that using long-term numbers, you get the results on the top. You get these low correlations, which are meant to dampen volatility, which is great. But what happens when everything hits the fan? Well, the numbers on the bottom are the correlation numbers there during the financial crisis. This is 2007, 2008, 2009. Everything kind of converges to one. So how do we address this? What do we do if the traditional risk mitigation techniques are just simply not enough? We'll be talking about the defined risk strategy and how that works, and I'm going to leave most of the option stuff up to Chris Hausman here. I'm going to direct most of those questions to him. Since joining Swan 4 years ago, I've learned a ton from this gentleman. You won't find someone who's more knowledgeable than options out there. So I'm going to defer most of those questions to him, but in order to set it up, to talk about the broad strategic direction of the composition of the defined risk strategy, that's where I'll kind of kick things off. So if I could sum up the defined risk strategy in just 3 simple words, or a simple phrase, it'd be always invested, always hedged. Now, yes, as we've seen, the markets do tend to go up, right? Now, whether or not that's through true price mechanisms, true valuations, or some of this other stuff that Danielle was talking about, who knows? Who cares? The markets do go up, so you have to participate in that. It does not pay to be a permanent bear, right? So you do need some equity participation. But what happens when the bear does show up, right? Well, our philosophy is then you should be always hedged. You should always have a component of your strategy, a portion of your strategy, which you know is inversely correlated to the markets. That's not hoping that the correlation table pays off for you, all right? Now, what is the disadvantage of remaining always hedged? Well, there's going to be a cost to it, right? There's going to be a drag to it. There's going to be an expense to carrying that protection if the markets are up, I don't know, say 10 years in a row without a dip or without a major sell-off. So we have to have another way of compensating for that. We have to have another component of the strategy to help subsidize the carrying costs of our hedge. And again, when we start talking about the details and how we implement that, I'm going to leave that up to Hausman. But the broad strategy here is like what I like to say, it's a 3-legged stool, right? Always invested along the markets, always hedge to protect, and yet we're always collecting some premium from the shorting of options to help lay off that hedge. Now, I realize I'm going through some of this a little bit quickly here. We can talk about this in a little bit more detail. We will also have at the end a Q&A session. We can really dive into these topics, as well as talk about 2018, which was admittedly a tougher year for the strategy. So the first question then is, when it comes to our long exposure to the market, how do we do that? Well, what we do is that we use passive ETFs, right? We go out there and invest passively in the markets and just buy and hold. Nothing different than what John Bogle would tell you to do. So the question is, well, why would you do that? Why aren't you trying to pick stocks and everything? I'm not sure if this is really a conversation we need to have here. I mean, a lot of people have kind of moved to this passive type environment. They say, look, beta's real cheap. You can get it for essentially nothing. And more often than not, your passive managers are going to be in the top quartile versus your active managers. So what we see here are different box plots plotting the index for U.S. large cap, U.S. small cap, foreign developed, foreign emerging, over periods of 1, 3, 5, and 10 years. And yeah, there will be the occasional active manager that does outperform the index, but it's just a simple, easy way to get that beta exposure very cheaply. That's what we do. Now, I should note that with our flagship product, with the U.S. large cap one, we do have a bit of a value tilt. We're still invested passively, we're still invested in ETFs, but we are equally weighting the various sectors so that you have a bias a little bit away from the FANG stocks, away from the tech stocks. We're overweighting essentially the value type stocks. Has that worked in the last couple of years? Not really, right? The FANG stocks have been killing it. The growth, go out there, you can find all sorts of articles talking about, like we were talking about in 1999, is value dead? Well, what happened as soon as the markets turned around? Value rallied, right? Nothing's ever really dead in the market, right? It's just always the pendulum swings back and forth. But we have been in a period here where the growth funds, the growth tilts have been beneficial. So there's really not a whole lot for me to say when it comes to the core equity exposure. It's pretty straightforward. It's pretty plain vanilla other than that value tilt. So let's then talk about the fun stuff, which is the hedging. Now, as you may know, what we do at Swan is we use long-term put options for our hedges, and those are always part of the portfolio. So one of the questions a lot of people have is, well, why? Why do you use long-term options rather than just buying something that only goes out for a month or a quarter? And for that, I'm going to turn it over to our options expert who can dive into the explanation why we use long-term leaps.
Thanks.
And how.
So this morning there was a reference to F-bombs, and just so everybody knows, I'm a former market maker at the Chicago Mercantile Exchange. And I chuckled because my friends were market makers, and when I decided to leave the floor and go to the dark side, right, the upstairs world, I got a tap on my shoulder one day and says, "Chris, you got to tone it down." And I said, "What do you mean?" I didn't, not in those exact words. And it wasn't until I left Chicago and I came back and I hung out with some buddies on an evening. And needless to say, I was appalled and disgusted by the language they were using. And that's when I learned what that tap on the shoulder was all about. So I'm not the presenter that Odo is, so I'm more of a fighter in the pits and that kind of thing. So that's, going back to why do we use long-term leaps? Well, it's about the normal distribution. And I'm going to break your hearts right now. If you're using your Stat 101 Gaussian normal distribution to make financial decisions, you're going to be in trouble at some point in time. And the biggest example I can use is back on February 5th of 2018 when we had that Volmageddon, which was mentioned previously. The odds of that happening from a volatility perspective is once in every 200 years. And Halley's Comet comes every, 75 years. And the next one's due in 2065. So I always ask people the question to kind of hone in. You have to throw away your Stat 101 book and forget about normal distributions because we deal with very, very fat tails here. And so my question is, well, who thinks that February 5th of 2018 will not repeat itself again before Halley's Comet comes in 2065? And usually everyone pretty much says it can happen again. It's a real risk that we deal with in the financial markets. So when you're talking about hedges, going back to the normal distribution, what you're doing with a hedge is you are altering that distribution because you're trying to do what? Stay invested as long as possible. There's a thing called prospect theory where we tend to do what? We sell our winners and we let our losers run. So if you can alter that normal distribution via a hedge, you can stay in the marketplace and not counter the effectiveness of having hedges. And two things that you need to look for in hedges are robustness and what is the cost of that robustness. And if you want to break that down further, you can break it down into convexity. And convexity is just a fancy word for bang, right? What kind of bang am I going to get on this hedge? The other thing is, well, what kind of benefit am I going to get? Okay, so, and then the most important thing about a hedge is reliability. And this really is one of the reasons why we use leaps, because they are reliable. We cannot market time. It's very difficult. And so they're going to provide a reliable hedge. And then we take those three things, convexity, benefit, reliability, and then see how does that cost, what's going to be the overall cost? What is going to be the decay on these options? Because unfortunately with options, there is a decay or time component that we have to deal with. So we have to measure all these different things and say, well, what are we trying to do here for a client? It's really protect ourselves over a full market cycle. And shorter term options aren't going to get that done because of the market timing aspect. And that's really one of the main reasons why we use leaps. In conjunction, shorter term options will have a higher theta component. So the longer term leap has about half to 2/3 of the theta component, meaning the decay. We're able to salvage a lot of the value over the life of that leap hedge as opposed to using shorter term options.
Okay, great. And that's actually kind of the next question we have here. Some people, they get like, yeah, I understand you should hedge, but why not use shorter term hedges? I mean, if I look at the price of an option that goes out for 3 months, those are pretty cheap, right?
Yeah, unfortunately, they can be sunk costs. They are more expensive. So the typical 5% out of the money 90-day option costs per annum 6 to 8%. At the end of December, and the market had started a rally that last week of December, that cost 10%. If you went 30 days, that cost you 13% for the year. Needless to say, in February 2018, those costs went as high as 30% per year. So what I'm trying to say is in times of crisis, times when you really need a hedge, it could be exorbitant. The cost could be exorbitant, especially if it's a strategy that does not incorporate any type of premium selling. So if you have a strategy that is, say, rolling quarterly and you have to systematically buy a hedge every 90 days, you could get caught into one of these storms where it's extremely expensive to buy these short-term put hedges. And again, it goes back to timing. Did you have bad luck with timing, et cetera, et cetera. So that's one of the trade-offs, between the long-term hedge and the short-term. I will be honest, though, the shorter term does provide, again, that bang, that convexity a little bit better than the long term. And that's a key difference between, well, what are you trying to hedge as a client? Am I trying to hedge out short, violent drops in the marketplace, which sounds like we don't need to worry about those because they just recover in a week anyways. But are you worried about the big one, the big 30, 40%, 25% drop off that could happen at some point in time?
Okay. That is actually a nice segue there to the next question here. You talked about the big 30, 40% sell-off here. Now, before I ask the question, I just want to take a second here to explain this graph that we're looking at. Swan relies on this a lot. I mean, heck, our own portfolio management team relies on information like this quite a bit. These are known as risk runs, and the way that we present it here is what we call the target return band. Now, just to take a second here to explain this, the diagonal line, the straight linear line there, that's the market. That's the straight up S&P 500. You're invested along the market in the Vanguard fund or the SPY ETF. You're going to go dollar for dollar up, but you're also going to go dollar for dollar down with the market there. So that's your baseline. Now, what we're trying to do by introducing these hedges is still have upside exposure, but as the market sells off, the more and more the market sells off, you get to that kind of flat area. These hedges start to kick in, and then you get into that full-on protection. Now, there will be a cost. There is that gap there. I mean, there is a carrying cost to having these hedges in all the time, but this is the type of experience that we are trying to create by having a hedged equity profile. Now, to the question. So the question is like, well, if we're trying to prevent these big 20, or not prevent, trying to protect against a big 30, 40, 50% sell-off, why is part of the defined risk strategy process selling the hedge after about a 20 to 25% decline in the market, well, from the strike price?
Well, statistically, I mean, we've defined bear markets as a 20% drop. So statistically, in all the studies that we've done, that's really the optimal place to hedge and where a lot of the performance comes, et cetera. So, like Mark said, these are, risk runs that we look at on a daily basis really to assess where we're at, where our strike hedge is at in comparison to where the market is, and really trying to manage this target return band or this glide path, if you will, to provide, the best risk-adjusted performance within these boundaries, et cetera. So, the biggest risk is sure, you drop 20, 25%, and then the market drops another 20, 25%. That risk is always out there, but statistically, this seems to be the sweet spot as far as rehedging is concerned.
Okay. And then just to add a little bit of color to that, I mean, I'll take you through an experience of how this was actually works when the markets do sell off. So we'll usually start the year with about 90% long the markets in those ETFs I talked about previously, and about 10% of our capital is allocated to these hedges, these long-term puts, these leaps. Now, it does vary. Sometimes it's more, sometimes it's less, depending on what the price is for hedging. But, if we were to start off the year about 90-10, what happens after a 20% sell-off or a 25% sell-off? Well, that portfolio is not going to be 90-10 anymore, right? Because we know that the market's going down 20, 25%, but we also know that the hedge is going to go up in value. So we get to this point where the portfolio might be, 30% of the value is tied up in these hedges. Well, what do? We can just sit there and do nothing, or we can, sell high, buy low. Essentially, we sell these hedges, which have been massively appreciated, and then reinvest into the market, which has just sold off by 20, 25%. Now, as Chris mentioned, yes, there is a risk. There is a risk that the markets continue to sell off, but this is actually a part of the process, something that we like to do. We're hoping for these opportunities where we have these dislocations, where we're sitting on this asset that is appreciated massively in value because the markets have fallen off so much. Now, the flip side of this question then is, okay, well, if you start off with a 90-10 type ratio and then the markets go the other direction, why don't we rehedge continuously to the upside?
Well, again, it's not uncommon for a market to be up 15% during the year. What's uncommon is that it turns negative by the end of the year. Again, it goes back to all the studies that we've done. If we're going to continuously stair-step this hedge up, it's going to eat away at our upside capture rates. And we're not going to meet those upside target goals, those target returns that we're trying to achieve. So we do rehedge intra-year if there's been large movements in the marketplace, fast movements, kind of like what we're experiencing right now in 2019. So it is something that we're constantly monitoring. Again, it comes back to managing this target return band. So we have to assess risk. We're very cognizant of where market levels are today in conjunction where the majority of our leap put strikes are, where that protection begins to kick in. So it's something that we're always assessing. But no, this is not a systematic approach like other strategies that every 30 days they do the same thing, or every 90 days they do the exact same thing. I mean, we are monitoring dynamically this risk component that is moving up and moving down. And that's what separates us, and that's what has really been the key for our track record over the 21 past years.
Okay. And kind of the flip side of that, I mean, yes, there certainly are strategies out there which are just like the black box. They're passive. They're doing the same thing every 30 or 90 days without fail. You know, if there's an active management component to this, the next question, I guess, is like, well, why doesn't the DRS just market time the hedge? Why don't we just, you know, decide the right day to start hedging and then decide the right day to take the hedging off? Softball here.
Market timing is very difficult. I think I have a collection of crystal balls. They all share the same trait. They're very hazy. I've switched it to Magic 8 balls lately and see if that works out as far as market timing is concerned. But it goes back to reliability. And I said, you know, why do we do the leap? Why are we one of the only ones that are doing longer term hedging? Because it provides reliability. And we're not going to be scrambling when that crisis happens. Because we've already gotten a taste for short term events. 5-10% sell-offs very quickly. 20% sell-off in Q4 of 2018. And they're painful. They don't taste very good. But one day, that 20% sell-off in that short period of time is going to turn into something longer. That 5% sell-off will turn into a 25%. And it'll be too late to hedge. So again, it goes back to the long-term lead provides us reliability of always being in the marketplace and not having to time that. What other strategies do? There are other strategies that are hedged equity, and they say in their statements, we may not have all the puts on if volatility is very high. It may be too expensive to buy some insurance. That's kind of a crystal ball to me. That's kind of making a market call or some type of somebody's making that decision to not have hedges on anymore. What do they know? I don't know that. The speaker previous knows a lot more about what's going on than I do in the marketplace. So I would rely on her on what she thinks is going to happen. But as far as again, it's always being in the market. We're always invested, always hedge, and that's been our motto for 21 years.
Okay, great. So that's two of the three major legs to the stool here of the defined risk strategy. Now, the last leg of the stool is the one that people, you know, have the most kind of trouble getting their brains around, and that's because, you know, options are still viewed as exotic to a lot of people here. So let's talk a little bit about that third leg of the stool there, the premium collection trades, or sometimes we call them the income trades. First of all, why? Why do we have these here? What part do they play?
I mean, the primary objective is to reduce the cost of the leap. That's the primary objective. So what we're trying to do is have free insurance. I mean, that's basically what you're trying to do. If you can add incremental income over and above that, that's even better. But the DRS is net long volatility, and by that, because we have long-term volatility, and then we have short-term volatility. So what we're trying to do is manage that term structure. And what's happened, it's long-term insurance versus short-term insurance, and the analogy that's always used is, well, if you buy rental insurance or you have rental insurance on a rental car, it's very expensive versus what you pay for the car that you have at your house the car that you have at your house for the whole year. Okay, so that's kind of the discrepancy or the risk premium, if you will. We're trying to take advantage of the differences between these volatilities out there, between short-term vol and long-term volatility.
Yeah, and to speak to that point, I mean, why are these trades typically profitable here? I mean, we are engaging in shorting volatility over the short term. So why has this type of relationship? Why after over 20 years has this been a good experience for us?
So we're looking at the risk premium here, which is there's two types of volatility that you have to deal with. There's option implied volatility, and then there's realized volatility, which essentially is just market movement. Okay. Because of behavioral finance, people are content overpaying for short-term insurance. And short-term insurance, just statistically, over many, many years, has not worked. So we short-term volatility. We sell that insurance. We sell that premium out to help fund the long-term. And that relationship is not always there. There are times where the markets move a lot more than what was priced in. February 2018. Last quarter, realized volatility won the game. First quarter of this year, realized volatility because, the type of market we want is more surf action. We want waves to come in and come out and go out, right? Net, no movement in the marketplace. And the real problem becomes when you are riding this river and it just goes one way. So January of last year was a one-way move up. We've experienced that again this year. The difference between this year and last year is that, well, the river went one way and all of a sudden we hit a waterfall, right, in February with the Volmageddon and all that kind of stuff. So it's not, 2018 was a tie for volatility, if not maybe the longs one, which is very rare if you go back in time in history. Long volatility, being a buyer of long volatility does not work statistically. And so we try to take advantage of that by selling out short-term volatility and taking advantage of that risk premium.
Okay. Yeah, so this is the fundamental relationship that we're trying to exploit here, this idea that there's this gap between what people are willing to pay for protection, and at the end of the day, what that protection's actually worth. That's this, volatility premium here that we were talking about. So then the question, this segues to the next question, is how do we typically, and keyword here is typically, how do we typically harvest this option premium?
So most people here are probably familiar with covered writing. So you're selling an out-of-the-money call, or you're familiar with put writing. So we combine the two, where we sell an out-of-the-money call. It's typically 4 to 5% out of the money, and then the put is about 8% out of the money. And that will ebb and flow depending upon market conditions, where volatility is, et cetera, et cetera. We do this typically delta neutral, meaning on inception there's no directional risk, and then we have to manage that directional risk. Because again, we're trying to take advantage of this discrepancy in risk premium. And let me go back to the risk premium. It's not an arbitrage, it's a phenomenon. I think a lot of people mistake that it's some arbitrage and that you can naturally take this. No, it takes work, and the work comes in active management, not passive management. There are a lot of strategies out there that will sell option premium and claim that they're volatility traders and they're taking advantage of this phenomenon, but the reality is that their performance is coming from delta, i.e. beta. Okay, I mean, I have this joke that if the market's going up, my 11-year-old can make money selling puts. That's as basic as I can get it, because it's an easy trade. I think the hard part is what happens when these trades go wrong. That's what separates the different strategies and the different managers. There are times in the marketplace where you should make money with these types of trades, any type of risk premium type trade. It depends on the market environment. But I think the key thing is really, well, when does it not work? When does a February 2018 going to repeat itself? When is a quarter 4 2018 going to repeat itself? In fact, Q1 of 2019 has been somewhat difficult because, again, it's that river. We haven't had the wave motion going back and forth, which is an ideal condition for harvesting risk premium. We've had this one-way river that's just not stopping. The market just continues to go up, and then that makes this kind of structure challenging. It doesn't mean that you still cannot harvest the risk premium. It just means the active management that we have and the adjustments that we make during this process are even more important.
Okay. Well, yeah, let's talk about that. I mean, there are certainly environments where setting this thing up and set it, forget it are pretty straightforward, but there are points when we do need to be more active and do some things. So can you just throw out some examples here? What are some examples of those types of decisions we can make as active managers to help mitigate mitigate the risk in these trades?
Sure. So we're always assessing market environment. And again, that means that this is not a black box program where the exact same trade is going on every 30 days. We have to assess volatility. The last 10 years selling the call has been a difficult proposition. If you're in a covered call strategy, fine, you have underlying against that, you're still making money. But another question I'll ask, how many naked call selling programs exist out there? None. You'd be out of business, okay? Covered calls exist because you're still long the equity, and fine, you give up some performance if the market rallies, but most people are okay with that because that's what they want. That's the need that they have as far as their portfolio is concerned. So, a lot of the defense and what we've been doing has been to the upside, naturally because the market has been rallying, and then sometimes the defense is to the downside when something violent in the short term happens. So some of the things that we can do is scale into the trades. We don't necessarily have a full position all the time. We could have partial positions. It comes down to expected value, and this is kind of how I explain it to a lot of people. If the market environment is not there, if that risk premium does not look healthy, we don't have to trade. We don't have to force the issue. So, there will be times where we're out of the market. It's just not working. It was the difference between this year and last year, where we were in the market in January 2017. That did not bode well, and then got hit, following, with the February event. And this year, we were assessing the risk premium in different ways and looking at it and saying this is just not conducive for the expected value, and had smaller trades on. We can capture, we can get out of trades anytime we want if we have good capture ratios, meaning we'll put a trade on, maybe we'll get out 10 days later because we've made our money, and we'll sit and reassess the marketplace. So it's not discretionary, it's still systematic, and there's a checklist that we go through to try to assess the market environment because markets, they do change, they're not the same. And so we have to evolve with that.
Okay, great. And that kind of eliminates the need for this next slide here because I talk about why don't we use strangles exclusively. Well, there's lots of other things we can do here, and I'm not sure. I mean, is there anything else you wanted to add about these different strategies? But you kind of answered that.
Yeah, there's a lot of strategies here. We don't just do strangles. I mean, premium selling and harvesting the risk premium doesn't necessarily have to come from shorting a strangle. There are other strategies: credit spreads, selling put spreads, selling call spreads. So you see these. Basically, what this slide is about is assessing your market environment. Are you in a high volatility or a low volatility type of environment? Because there's a strategy for that. Also, where are you in the market cycle? Is it bullish or bearish? So again, this kind of goes through that checklist on what is the right trade given the market environment that you're seeing. This slide represents something else to me. It says it should be renamed, relabeled, interview your client, because there's a lot of strategy here that I'm sure a lot of people don't know what these things are. But your job, our job, is to interview the client and make sure to understand what is it exactly do they want. Are they seeking hedging? Are they seeking income generation? Perhaps they want additional upside capture. And so this is kind of where our jobs and your jobs as advisors come in and say, well, what does a client really want here, and what do they really want to do with their portfolio? Because a lot of the times, they don't really know what they want to do with their portfolio. And because options is relatively new to a lot of people, this is where, okay, if we explain it, here's an environment, here's a structure, this fits with your end goal, and that's where we come in.
Okay. Right. Now, you talked about the market environment here and trying to figure out where we are in terms of volatility in both market direction. That kind of segues to this next question that we have here, because one of the kind of pushback, one of the topics of conversation is, why does it seem like these volatility spikes are happening more frequently? Has something fundamentally changed in the market, and if so, what is that?
So 2018 had the most amount of spikes. I believe it had 12 in the previous year. Before that had a lot, was 2011 with 9. So if you take the last 10 years or so, there's been approximately 57 spikes. If you go the 18 years prior to that, you only had 33 spikes. So you've got an increase in here, and a lot of it has to do with technology. I mean, we all get information much quicker. There's a lot more education out there. There's a lot more people who are aware of the risk premia. We also had this buildup of short volatility in the system. A lot of that's out because of what happened in February of 2018. So I am familiar with Chris Cole's work. He does talk a lot about short volatility. Short volatility, this is what I want everyone to understand, though. Short volatility is not a bad thing. Short volatility, when you leverage, can be a bad thing. And that's the key difference. A lot of strategies are levered. And even though they are claiming, well, we have an unlimited risk strategy, it's a spread, you can only lose X amount, and it's definable. That's great, that's a true statement, but they have 5X or 8X or 10X of those. So they have levered up. I mean, and that's one of the key things. And when I talk about risk and going through due diligence, it's really understanding, there's this term called net units, because at the end of the day, you've got long options and short options, and they have different risk reward profiles. So it's always knowing about, what are your net units, what is your true exposure, because a lot of risk metrics, Sharps, I mean, Sortino does a little bit better, but once you start putting options into a portfolio, these traditional risk metrics, and you can talk about it more, they don't really quantify the true risks in options portfolios. And I think that's what a lot of strategies, they're telling you that you have limited risk, but you really don't, because you are levered in a certain way, shape, or form. So. Yeah, and
I'll get a plug in here. Chris and I collaborated on a paper. Was it this year or late last year? Something like that. Called what do we call it? Learning from the mistakes of others. And essentially, yes, there's this tendency for people to treat all option strategies, all options in general, the same. And the idea here is like, no, options in and of themselves are not risky. What is dangerous when you look at the track record is the guys who got in trouble: leverage being the main killer, liquidity, and then risk controls. You're not paying attention to risk controls, not having your risk controls. If you look at the track record of those blowups that have happened, usually it's one or not, if not one, all three of those things: leverage, liquidity, and risk controls have gotten people into trouble. And the funny thing is, it's not just options, right? I mean, like all sorts of financial crises have been caused by leverage, liquidity, and lack of proper risk controls.
Yeah, in other words, fat tails. Okay, so again, go home and throw your Stat 101 book in the trash can. It's not going to help you in this business. It's not going to tell you what real risks are out there. And so again, going back, when I was on the floor, if you guys are familiar with Victor Niederhofer, he had this great strategy that he would always sell out of the money puts all the time. And, did very, very well, except when an event happened. And I remember being in the pit in the S&P 500 when he had to come in. Basically, the Merc is very vicious. You start getting margin calls, they're just going to go in and liquidate your position. They don't care. And so this was over at the Mercantile Exchange, and they liquidated his positions, and I was on the other side of those trades, and it was a great day for me. He accused market makers of jacking up prices in the Wall Street Journal and wanted to sue us and all that, but it's the marketplace at the time. So that kind of price dislocation doesn't exist anymore because of the transformation over the last 20 years in the marketplace. I've seen it go from open outcry fractions. I'm very fast with my fractions, a skill that I don't use anymore unless somebody asks me what a teeny means. So I've seen this transformation from open outcry to electronic trading, and it's a good thing. It's a good thing for us. It's a good thing for your clients because, to be honest with you, we wouldn't be here. I mean, a lot of the options-based strategies would not exist if there was still an open outcry system where you traded in fractions and you had huge spreads between bid and ask. Right now, if you look at prices, you'll get option prices and spiders, talking penny wide, very efficient. There's really no more theoretical arbitrage between option prices. We all know what an option pricing model does now. So that's been taken away, and that has created our business and your business, and to be able to incorporate options, not because I guess I want to call it the VIG, right? The difference between the bid and the ask. That is no longer in a market maker's pocket. It's in our pockets. It's in our clients' pockets, and then we can turn around and use options for good things, hedging, income generation, and so forth.
Okay, great. Now, before I leave this topic, there is one thing. I mean, I want to get back to House's experience, having done this for 20 plus years, because there's something I very much liked when he answered a question previously. This topic came up. It's like, why are these volatility spikes more frequent? Now, and House says, look, if someone says to me, I've never seen this before, no, if someone comes to me and says, we've never seen this before, House's response is, no, you've never seen this before. You're new, I've seen it before. Which is, true, right? I mean, you come around, you stay around long enough, you see all these different things. You see periods where people's like, oh yeah, it's a different market now. There's no volatility, or it's a value market, or it's a growth market. It's always a pendulum that comes back and forth here. So the next point is like, all right, we went in kind of a deep dive there. Let's take a step back here. And how do all these pieces come together? We talked about the defined risk strategy having 3 major components. I can also illustrate those components here visually in what we call our target return band. Now again, we've talked about 2 of these 3 components already. The diagonal line is our long exposure to the market. That is the buy and hold position in the ETFs. We changed that basic structure by having those hedges on there so that we get some of the upside but protect against those major sell-offs. This is kind of our guiding principle here. Our goal is to hopefully put numbers up that plot within this graph. So the next question is like, okay, if that's your goal, how well have you done it? So over the last 20 plus years, we've gone ahead and plotted out the returns for our separately managed accounts in this construct here when you put those different pieces together. And more often than not, we are in or above that line. There's only one period when we were significantly below, and that was 2003. But beyond that, we have been able to hit our goal of remaining in or near or above that target return band. Now, if you do that, how does that consistency help you? And what you've probably seen before, too, is what's known as our spaghetti versus rope chart. When you produce consistent results, it doesn't really matter what the market environment is. Now, let me take a second to explain this here so we can know what we're looking at here. This graph has changed a lot on the left side, on the S&P side, over the last year or so. But what we're seeing here is 10-year returns. These are decade-long investments in either the S&P 500 on one side or the defined risk strategy in the other. So the only difference here is which New Year's Day did we make that initial investment? Was it New Year's Day 1998? Was it New Year's Day 2005? And what we'll notice here is that there is a lot of variability in the S&P 500. You had a lost decade. You had periods where you doubled your money. But guess what? Had you put your money to work in the beginning of 2009 on that thing, you would have almost increased in fourfold what your money is. I mean, that's a black swan, the black swan to the upside, right? Now, on the other side, we've got the defined risk strategy, right? Now, the defined risk strategy, always invested, always hedged, and it includes one of those periods that has no bear markets, right? We got that period, one of those lines is that same period, and guess what? The strategy still produces that same consistent type of result. Doesn't matter if you get the screaming bull market or some of these god-awful bear markets where you actually have a lost decade. Now, of course, we will talk about 2018 in just a second here and talk about some of the more recent performance stuff. But before we leave that, we want to talk about where does the DRS fit within a portfolio. So there's lots of different options here. No pun intended there. There's lots of different ways you could potentially use this. Some people use the defined risk strategy as their core equity exposure, as a supplement to their core equity. And I'll have some more details on some ideas on how you could do that. Because once you take a look at the long-term numbers, by hedging out that downside risk, the DRS has outperformed if you have a long holding time horizon of 10 plus years. Almost 3/4 of our 10-year rolling numbers are outperforming the S&P 500 by mitigating those big bear markets. You could also use it as a fixed income complement. This could be the protection portion of your portfolio. We talked, Danielle had some just mind-blowing stats about the fixed income markets and bonds. I mean, does anyone really think that an 8% return on bonds are feasible going forward like they've given us for the last 40 years? I mean, I can't even imagine what kind of economic environment would be so deflationary that a bond yielding 2.5% is a great deal. It's going to get you an 8% rate of return. Of course, we do get bucketed in the absolute return or alternatives category sometimes, and that's fine, and we don't track a benchmark very closely, so yes, you can make the case that this is more of an absolute return type strategy or an alternative rather than just being a hedged equity, or excuse me, as a core replacement. But let me give you an example here of how this might work. One financial advisor I worked with has some really great ideas. He says, look, I've got clients across the board. They're all different. I've got young clients. I've got old clients. Now, with my older clients, they're more conservative. They might be 30% in equities, but 70% in the very traditional, high-end fixed income. Talking muni bonds, treasuries, so on and so forth. Now, the yields on those are so low, I know I need a bit of an equity kicker. So I need at least, call it 30% that's invested, but it terrifies me to have 30% long the S&P 500 for someone who's already in retirement, right? Very conservative. So what do? Well, they use the defined risk strategy there as their equity, but it's a hedged equity, right? It is exposure to the markets, but it has less downside, less beta than you would have of just having a naked S&P 500 unhedged exposure in there. Now, the flip side, the same gentleman also has younger clients who have the ability to invest in more alpha type strategies, can be a little bit more riskier or weighted towards equities, but he can't go all in, right? He needs some ballast to the portfolio. He needs something to de-risk the portfolio. So in that case, rather than having just straight up bonds, he's using then the defined risk strategy as his ballast in the portfolio. So that's an example. Now, I do want to talk about some of the stuff that we've experienced more recently here and also leave time for questions. So certainly, you look at the long-term numbers, they all look fantastic. 2018 was a rough year for the defined risk strategy. And the way I would maybe approach this question is kind of ask a hypothetical question. If you were to sum up 2018, the whole year, in just one statement, describe what the markets did over those 12 months, what would that one word or statement be? It'd be very hard to do, right? Because it was a very strange year where the market was doing all sorts of different things. So what makes you think that like a single number can encapsulate into all of that year's experience? 2018 really can't be wrapped up in a single number. So the way I've been explaining the 2018 performance from the market level is say it was really a year in 3 acts. All my year-end stuff was a year in 3 acts. And I'm actually going to revise that a little bit. I think it was the year was 2.5 acts, all right? And I'll explain that in a second. Because the first quarter of 2018 was what I called the whipsaw days. The markets were crazy, right? They went up like a bottle rocket led by the FANG stocks. Everyone was loving growth back then. And then what? We had a full-on correction, right? We had a 10% plus sell-off in the span of a few weeks. And then the markets bounced back up. And then they sold off again. So that first quarter, we saw a very volatile period. And where we got hurt, where the defined risk strategy did struggle, was for 2 components there. One, we had equal weight, the value tilt to the portfolio, underperforming the S&P 500 to the tune of over 200 basis points. So that hurt, right? Our value tilt, while the FANG stocks are screaming, hurt the portfolio. There's no denial. And the second was with these whipsaw markets where volatility is going back and forth, it's very difficult for those premium collection trades, and that also detracted from our performance. Now, was there anything that you wanted to mention about that first quarter to add about how tough it was in that type of environment?
It was the first time we'd experienced that because not only do we have pressure on our income trades from the market rallying so fast in the first 3 weeks of January, but then just a couple of weeks later you have the event of February, which I said statistically, right, on a normal distribution should only happen 200 years. So again, that's definitely a time where there were other strategies scrambling, and we go into defense mode and try to limit losses, because the most important thing about the income trades is not the making money part. That's the easy part. I already said that, right? It's the not losing the money part, because you want to preserve the right side of that equation, your expected value. If you have leverage, or you don't have discipline, or you don't have active management, or you're not assessing risk on a constant basis, you can let that loss get away from you. And once it gets away from you in this business, it's not coming back. It's going to take a long time to come back. And so we will take losses on our positions. And we will continue to take losses on our positions if we feel the need for, at the end of the day, to preserve that expected value.
Okay. So that was a difficult, very, very, very difficult first quarter, the Act 1 of 2018. Now, the middle act of 2018 was something I called everything's fine, right? Everything's fine. What did we see in the second and third quarter? It was like a repeat of 2017. In 2017, the market was up 12 months. Every single month, the market was up. Had never happened before where the S&P was up 12 for 12. What did we see in those middle two quarters of 2018? 6 for 6, right? If you annualize the numbers from the middle part of 2018, guess what? It syncs up with 2017. So it almost felt like people in the market were wanting to turn back the clock and pretend everything was copacetic like it was in 2017. And that worked for about 6 months until we get to what I had termed Act 3. Now with Act 3, I said, okay, quarter, the market sold off. You know, we almost touched a bear market. We didn't quite get there. It was 19.36% on the downside. But the reason why I say it's now Act 2.5 is because I'm tacking now the first quarter on to the last quarter of 2018. We had essentially the same type of thing that we saw that Danielle talked about in 1998. We had the markets go down. What happens? The Fed panics. They do what they do. The Fed put is still alive and well. And now, boom, we're setting all-time highs here. So in that environment, if you look at the round trip, you know, in the first quarter of 2019, we've done quite well with the DRS. Now, we're never going to catch all the upside. That's never the promise in a rising market. But we're in a much, much better position here in the first quarter of 2019. One, because our income trades were about break even. We didn't get burned but like with the whipsaws. And two, the equal weight, the value has not quite been the detriment. I mean, it hasn't outperformed in this screaming growth market, but the gap there isn't as bad. So if you look at that kind of round trip thing, just like the markets recovered all their losses in about 6 months, you know, we're kind of in the same situation where we're essentially have gotten through that. And I get back to the point that what is the primary objective of the defined risk strategy? It's to prevent the big, long sell-offs that last, you know, years rather than a few months and are down 30, 40, 50%. I've been running around a lot lately and haven't been able to publish this, but the next kind of blog post I'm going to put out is on the topic, when is a bear market not a bear market? And I've got 4 examples going back to 1990 where the markets almost hit that 20% mark and then recovered. And it's really, really interesting because all 4 of them, you see the markets go down, it takes about 3 months. And with the bounce back, 3 of the 4 were back in 4 months. So it follows this kind of V-shaped thing. And again, you could make the argument, like Danielle said, that the Fed put is what rallies the markets in something like 2011, August of 2011, or if it's 1998 with long-term credit, or more recently, and we saw this most recent turnaround. But I think that's not what people's fears are, right? People's fear is like, when is the Fed put not going to work? When did the Chinese finally put in a new monetary policy where they don't need to buy treasuries anymore? And those are the kinds of things that are really the types of things that people should be concerned with. So certainly happy to talk more about, you know, more recent performance as well as the basic structure to these different things. I don't think we really had any more prepared questions here. So at this point, I'm just going to go ahead and open it up. Yes, sir. I think there's a mic coming around. It's right behind you.
I know that you have a strategy of each January resetting the safety net, but there have been several years that this year is turning out to be that way where you're up double digits. And I'm wondering if you've ever thought about, instead of being on a strict calendar year, if instead saying when we move up at a certain point, that becomes our new point and it's 2 years from that or something along those lines.
Glad you asked that question. I'm going to let you address the upside rehedge.
Sure. So it comes back to managing that target return band. And the calendar year is more of a last safety, I don't want to call it a safety net, but we just, if something hasn't happened during the year where we haven't done some type of rehedge, then we'll go ahead and do it in December or January or towards the end of the year at some point in time. This year, because the market has moved up quite a bit, like you said, in a fast period of time, you know, we're, again, goes back to the target return band where we're assessing risk and trying to provide this smooth glide path. So we actually have done a rehedge this year and moved up some of our lead puts. So we're very cognizant of where the market is. We're very aware of where our leap hedges are, et cetera, and taking action to make sure that we stay inside that target return band.
Yeah, so that add a little bit more color to that. It was a partial rehedge. We had our usual allocation to the put options, and we moved about half of them up through the end of the third quarter, or excuse me, end of the third month and into the fourth month of the year, kind of ratcheting that up. So it's certainly the strike price is higher than it was at the start of the year. And again, then the next question people ask is, well, why didn't you do that in 2018? Well, the market was only up 10.6%. Is it really worth it to do it after the market's up 10.6 in September 30th? I would say no. But with a big move, an abnormal move like we've seen, up over 20, 25%, yeah, we did, and we're not robots, so we went ahead and made that change.
No, it was not across all four, because emerging markets and foreign developed are only up about 10%. Obviously, we're monitoring them, and if we need to, we will perform a partial rehedge. We did do in small cap. We actually did small cap before we did large cap. Yeah. So again, it goes back to managing the target return band across all of our products.
Yeah, and then that helped us. I mean, I'm not going to say that we were outsmarted the market here, but it was lucky for us in the sense that we did our rehedge because the market moved up so quickly. January, February, we did that. What happened in March? The markets did sell off a little bit. So taking that move did benefit small cap. Yes. Other questions? Joe?
Yeah, I was hoping to get a takeaway about any thoughts about how you're changing the way you manage the third rail, the writing put options and writing call options, and if we're in a sustained environment of short-term volatility spikes, which basically we have been since 2011, and it has very adverse effects on total return and the strategy. How do we explain that to our clients? Because what behaviorally people are saying is, I thought this thing was hedged, and why am I going down just as much as the S&P? And aside from the equal weighted thing, but one question about that, have you ever thought about on the equal weighting going back to the market cap weighting, and if not, maybe throwing out value trap sectors? Just a curious question.
Yeah, we'll address I'll let Chris address the first one about the premium collection trade, which is the third leg of the stool. I'll get back to the equal weight.
So again, it goes back to reassessing the risk premium, what kind of environment we're in. The methodical, robotic approach where you're guaranteed to go through every single one of these events. I just don't think that works in this type of market environment. Obviously, we showed the slide with all the VIX spikes, like you mentioned. So again, it's more through the systematic approach, more active management. And remember what the number one goal is to try to recoup the theta of that leap hedge. Okay, we want free insurance. I mean, we don't want to pay for it, but we're not going to take undue risk. We're not going to leverage like other programs do. So right now it kind of goes back to what he said earlier. We've seen these events before. The VIX spikes, I think, are going to lessen moving down because there was just so much short volatility pressure that's been relieved. We didn't have any VIX spikes in 2017, and everyone was saying, well, volatility is never coming back. It's going to be low forever. These are the exact same words I heard in 2004, 2005, which was another similar volatility regime. And even 2018, I call it the volatility sandwich because you had Q1 high vol, very low Q2, Q3, resembling 2017, and then Q4 high vol, but from something else in the marketplace. That wasn't because there was so much, VIX and XIV, type of pressure on the marketplace, right? All these short volatility products. So again, I know that we have been monitoring that. We're definitely aware of that. So there have been implementations and changes to avoid and assess the risk premium. If it's not healthy, then we're not going to be there.
Okay. Now, to answer the second half of your question there, Joe, talking about the equal weight thing. I mean, essentially, the reason why we do the equal weight is the same thing that you hear from all the smart beta players, or if you ever, if you're into the Fama French type stuff. I mean, the complaint that those guys have always had when it comes to the S&P 500 is that it's a cap-weighted index, and therefore, the only thing that matters is a stock's price. Whether you like it or not, the bigger the Facebook or Amazon gets, the more you have to buy it. Throw valuations out the window, you just have to buy it. And with this whole tilt that we've seen towards this huge upsurge in passive management, I think that phenomenon is being exacerbated. Now, that being said, that's what led to all these people in developing things like smart beta. So I look at the whole equal weight thing as just being another way to have value in your portfolio. Now, in hindsight, being 2020, should we have done that right at the time we did it? Probably not. But then again, we probably shouldn't have had a hedge on for the last how many ever 10 years either. This is a long-term play. It's a long-term strategic bet that we are taking towards value. Now, that being said, there are a couple things where, again, we kind of enter discretion. I mean, one of the things that's changed, two things that's changed since we had the equal weight come on was that real estate was carved out and treated as a separate sector. Did we just want to automatically treat that as an automatic allocation? No, we looked at it and says, like, look, this doesn't really make sense, and it gets us even more into that value type tilt. Let's just continue to weight it as it was, as if that real estate carve out never happened. That was one example. Now, more recently, we had the communication sector being created, right? They pulled some out of tech, they pulled some out of consumers, and they created this new one. And we looked at that and said, like, yeah, you can make the case, and that would be easy for us to implement. And actually, that actually helped, maybe tilt us back towards the growth side. So, it's not a pure value play, but if you look at the spectrum, that change kind of got us a little bit closer to what the market is. And it was, obviously beneficial for us here more recently. Yeah, we always ask these things, we always think about it, but of course, you have other considerations too, like taxes and stuff like that when it comes to the mutual fund. Yeah. I think yes, sir, you got the microphone.
Yes, I have two questions actually. The first is when we're looking at the long-term track record of volatility, realized versus the implied. In general, if we're trying to manage clients' expectations specifically to either the negative or the positive returns coming from the income trades, would you say a general rule of thumb is that as we get closer to the actual correction, you're going to tend to see more of those spikes take place, and as a result, maybe leading up to a correction, that it's not going to perform as positively, or at least that piece of the portfolio?
I mean, it's hard to say. We realize volatility goes both ways, on the upside and the downside. So I think we do actually like a higher volatility regime, one that actually is sustainable. We just haven't had any high volatility regimes that are sustainable. Go ahead and look at the VIX and see as soon as the market starts to rally, it collapses. So that has been one of the challenges, that if we do go through some type of volatility spike and it adversely affects the performance of the fund, well, we have not had these clawback periods that we have historically. So I think one of the, what we've been a lot more aware of is we'll try not to be around for the events. Now, we can't predict what's going to happen in the overnight markets tomorrow, but we're actually always monitoring that as well. So the good news is, even though we went through that type of event in the first quarter of of last year, we clawed all that back in Q2 and Q3, and then we got hit by another event. So it really comes down to, how many times are we going to have these events? Is it really going to happen 2-3 times a year? That will make the income program challenging. I mean, there's no question. But normal volatility spikes, I mean, there were 18 or 12 in 2018. It didn't mean that we lost money on all 12 of those trades. We lost money on 1 or 2 of those trades. So again, it comes down to managing when it happens. But yeah, there'll be some that are worse than others, if you will. So again, it comes down to the active management. And we've been through this before. These aren't the first time that these volatility spikes have happened. I have news for everybody, that won't be the last time. So it just comes down to managing the relationship.
Before you ask the second, Kathy, I'll add a couple things. You asked, how do you explain this? How do you manage expectations? And it actually kind of gets back to your point there too, Joe. 2 things. We did about a year ago, again, Chris and I collaborated on a paper called Managing Expectations. It's very thick, it's very dense, but we've talked about about every type of different scenario. This, that, the other thing, all the things. It's the magnitude of loss, the speed of the loss, the duration of the loss. All those things come into play. And for your own, understanding, I would recommend checking out that piece. Now, when it comes to the question about volatility, the way I like to explain it sometimes, and this is a very simple way that maybe the clients would like, is like, well, we want to be Goldilocks, right? We don't want the volatility to be too hot. You don't want it to be too cold. You want it to be just right. And House has always said that you're kind of the sweet spot when this is where we tend to like, is when the VIX is kind of in that 13 to 18, 12 to 18 range is typically when your job gets easier. It's when it's on the other side that it gets harder.
Yeah, and I didn't mention this, but option implied volatility has a tendency to undershoot when volatility goes high. I actually am very afraid of high vol. I like the Goldilocks 13, 18 area. That's when the risk premium is very healthy. It's actually healthier when you're in a low volatility environment. Okay, when realized volatility is at a 7 and the VIX is at a 12, that's actually a very healthy environment. The risk there is that 12 VIX could become a 24 VIX overnight if something happens, and that's what happened in February 2018.
So the second question is going back to the other gentleman's question, which is the value side of it. So you mentioned that one of the things that's exacerbated the problem is the rise of, the index side of things. So I guess one question I would have is, if you're going to continue the strategy with the value tent, are you expecting indexing to become less than what it is now, or do you continue to see that as an exacerbation? And then just kind of a tie into that as well. I think all three of your other strategies are market cap weighted. So I guess that's one of the frustrating things in terms of, as an advisor trying to set clients' expectations, is that this is the only fund that you guys have chosen to choose to do this with.
Right. Yeah, I'm going to address the second half of that question before I get back to the index one, passive versus managed, because I think that's a rich topic. Now, I do know that we're coming up on time here, but we're okay? Another 5 minutes to noon, maybe? Okay. The question about equal weighting the S&P 500 versus the other ones, we have looked at that in the other topics, like, do you want to equal weight countries? Do you want to equal weight? First of all, the liquidity in the beta exposure is just not there. I mean, there was sectors on the 600, the S&P 600s, but I think they were actually all shut down because you just couldn't do that even if you wanted to in the small caps. And then if you look at some of the other ones, like the countries, again, it's like we don't want to buy individual country ETFs do that. It would just be very, very hard to implement. I just don't think the advantage is as wide there as it was, at least historically, on the other side. Now, I want to talk about the big question there is this whole active versus passive thing. Are these trends expected to continue? It's interesting because people always fight the last battle, right? And it's not just people willingly choosing to take index funds. I mean, I think there's a big push, especially, heck, Joe, you'll see it in the defined contribution where like the regulators are pushing people to the cheapest option. So you're pushing all these people to the index type funds, the equity fund, or the passive funds. And this whole active versus passive thing has been around for a very, very long time, right? But when has passive really won? It's been in the last 10 years. Well, how many bear markets have we seen in the last 10 years? None, right? So the point I'm getting at here is that this thing is finally tilted where it looks like Vanguard and the ETF providers have passively won, have finally won this argument. But the thing is, you're going to catch all of the downside, right? And people haven't experienced that yet. I guess that's the point I'm trying to make here, is people think that low costs are going to save the day, but whoa, hey, what's this doing? Well, it doesn't matter. I'm not talking to that. That people are just fighting the last battle, and the thing is that index funds can't play defense, right? Now it's great when you're riding the market up 376% off the bottom, but you're going to catch every bip on the downside if you're invested in the Vanguard fund. So I think the pendulum again will swing back to the other side once we see a true bear market. People are going to say, wait, I don't want all of the downside. Now fee compression, that's a different thing. I don't think the fees. That's not probably going to go back up the other direction, but. I don't think it's going to be passive forever.
Mark, before we wrap up, just if you would comment, and I'd invite Chris if you want to comment on this as well. Joe brings up a good point, and it was talked about, the difference we're using a equal weight versus cap weight. One of the things that we've designed over the last few years is our growth strategy. So if you would speak to that, and then maybe the multiple structures, we can accomplish all of these strategies in SMA form, as well as custom overlays on your existing beta. And we're going to talk more about this afternoon, but maybe talk about the growth strategy.
Yeah, after lunch, one of the topics we have is different ways that we can implement these same core concepts, these three legs of the stool, in different types of formats or with different strategic objectives. And that's really the thrust of one of the later conversations. But the question that Jamie asked specifically was one of our newer solutions, which is a more aggressive fund. Now, look, the idea that this that we have with our flagship product, the mutual fund, is that this is the one-stop shop. If you want hedged equity, this is our best idea for just having all those things wrapped up into one bundle. But what if we have different clients? What if we have people say like, yeah, I don't want that much protection? Well, we've rolled out the growth fund we've been running the strategy since 2015 internally, but it's now available for purchase as a 40-act fund starting late last year. And obviously, with the market up 13% in the first quarter, this thing's going to do great. It caught over 80% of the upside. Now, of course, had the markets gone down, well, it might have been a different story, but the idea is that this is a higher beta product, that, it's going to have less on the protection, more of the upside capture. So if that's the strategic objective, now we have an alternative. We have something in the stable that's a little bit more aggressive. Now, in the session after lunch, yeah, we'll talk about all these other things that we can do. We can talk about, customized solutions. We can talk about things rolling up and forming aggregate portfolios where we put all this stuff together. That's really the topic for after lunch.
Okay, great. Thank you, gentlemen. We're going to break for lunch now, and we'll be back in 1 hour. Oh, yeah. Danielle's out signing books. Thank you, gentlemen.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.